Someone sent me a number this week and said, "Tell me what you think." Here's that number. Over the past 12 months, silver miners are up 126%. Gold miners up 99%. Silver itself up 108%. Gold up 49%. The S&P 500 up 14%. Bonds up 1%. And Bitcoin down 21%. Go back and read that again. The asset that half the internet spent 5 years calling digital gold, the one thing that was supposed to make physical metals irrelevant, is the only negative number on the entire list. Meanwhile, silver miners handed investors 126 percentage points in a single year, not a decade, 12 months. That is the backdrop for everything I'm about to tell you. I'm John Egg. Today we're going to build on that context because there is a lot to unpack. From the latest vault report to one of the most respected technical voices in monetary metals, making a call I cannot stop thinking about. Let's get into it. Let's start with what's happening right now, because the immediate situation is too important to skip. Today marks the final trading day for the March silver contract on COMEX, the last day of the delivery period. Holders still sitting on open positions have 3 options: roll into the next contract, accept cash settlement, or stand for delivery, meaning they actually want the physical metal in hand. Yesterday alone, 275 delivery notices were issued. At 5,000 ounces per contract, that's 1,375,000 ounces that walked out of the system in a single day. And here's what's wild. After those notices went out, open interest on the March contract actually increased by 106 contracts. On the second to last day of the delivery period, with the clock almost expired, new positions were being opened. Not rolled, not closed, opened. People demanding metal. That tells you something, not about price direction necessarily, about behavior. Someone looked at the same vault data I'm looking at, assessed the same physical scarcity, and decided they want the metal today. Not a futures position. The actual silver. Here's what the registered COMEX inventory is showing. The pile has dropped 13.2% in the last 30 days. That's 11.6 million ounces pulled out in a single month. The coverage ratio, which measures what percentage of outstanding paper claims could actually be satisfied with available registered inventory, sits at 13.5%. Anything below 15% is considered stress territory. Historically, that level has been associated with delivery squeezes. Paper leverage is running at 7.4 to 1, 7.5 paper ounces for every single physical ounce available for delivery. At the current pace of withdrawals, registered silver would be exhausted in roughly 131 trading days. February saw 5,036 contracts delivered, 25.18 million ounces. The highest February delivery volume in modern COMEX history. January before that saw 33.45 million ounces leave the vaults in just 7 days. That was 26% of the entire registered pile gone in 1 week. March is tracking towards similar numbers, and April 1st, first notice day, is only 3 business days away. There are still 1,830 open contracts on the April contract. That's 9.2 million ounces of incoming potential physical demand. This isn't a 1-month fluke. This is 6 consecutive months of delivery demand running above historical norms with zero sign of the pace slowing down. Now, outside the vaults, the world is sending the exact same signal, just in a different language. This week, Bloomberg reported that the Turkish central bank sold and swapped approximately 60 tons of gold, more than $8 billion worth, in just 2 weeks following the outbreak of the Iran war. 6 tons in the week of March 13th, 52.4 tons in the week of March 20th. Some sold outright, most used as collateral in swap agreements to secure foreign exchange or lira liquidity, a government liquidating sovereign gold reserves to defend its paper currency. Covering obligations that paper money alone can no longer hold together. This brings me to a photo that's been circulating this week, and honestly, it explains more than any report I could write. A jewelry store in Bilecik, Turkey. A man in a black shirt and paisley tie standing in front of his shop window. 3 handwritten signs taped to the glass. The first opens with Vallahi, the Turkish equivalent of swearing on everything sacred, on God, on your ancestors, that what follows is the absolute truth. The second sign, 28 years as a jeweler. First time there is no gold. The third sign, printed large, if we had it, we'd be selling it. That man didn't write a market analysis. He taped 3 pieces of paper to a window, and in those 3 pieces of paper, there is more clarity about where the physical gold and silver market stands in 2026 than I find in 80% of the financial commentary I consume every week. When paper currencies crack, or even appear to crack enough to produce fear, people reach for physical gold. When physical gold becomes unavailable, or when it's trading at $5,000 premiums above the international benchmark, the way it has in some cases in Istanbul, people reach for silver, not as a consolation prize, as a market clearing mechanism. That's how it works. The empty display case in Bilecik and the draining COMEX vaults are the same story told from opposite ends of the supply chain. Now, I want to take something seriously that circulated in the monetary metals space this week. Something that raises an eyebrow at first, but deserves a genuine look. Michael Oliver, of Momentum Structural Analysis, entered the futures business in April 1975. He worked at E.F. Hutton in New York, where his boss was chairman of the COMEX. He developed his proprietary analytical methodology in the 1980s. And he went publicly, on record, calling silver to 100 when the price was still trading in the 60s. In a recent interview, he said, and I want to be precise here, that when this thing fully releases into a new pricing reality, silver is probably going to reach $300 to $500. $300 to $500. This is the same analyst who technically anticipated the 1987 crash, the same one who called the January pullback from the 121 high as a correction within a larger bull market, not the end of the move, and was right. He is now saying 300 to 500. My first reaction is the same as yours. That number sounds extreme. But my second reaction, the one that actually interests me, is this. What's the framework? Because if there's a logically consistent set of premises behind that number, then it stops being a wild forecast and becomes the natural output of a specific argument. You can disagree with the premises. The first pillar is the 50-year range breakout. Silver oscillated between roughly $5 and $50 for half a century. From the wreckage of the Hunt Brothers collapse in 1980 all the way through 2025, every time silver approached $50, it failed. 1980, 2011, every attempt met with resistance and reversal, followed by years of consolidation. Then in 2025, for the first time in 5 decades, silver broke above $50 and didn't come back. It kept going, all the way to $121.67, touching the all-time nominal record on January 29th of this year. The argument is that when a market finally escapes a multi-decade range, the expansion that follows historically tends to mirror the size of the range itself. Measured logarithmically, the range from $5 to $50 spans $45. Applied from the breakout point on a logarithmic scale, that projection lands around $500. That number isn't being invented. It's the direct mathematical result of applying a standard breakout framework to the range dimensions. The second pillar is the gold to silver ratio. In 2024, silver was priced at roughly 1% of gold, a ratio of about 100 to 1. By spring 2025, that ratio had compressed to around 50 to 1. Silver had doubled its value relative to gold in under a year. Today, we're sitting near 50 to 1. The historical extremes? At the 1980 peak, silver reached 6.5% of the gold price, a ratio of 15 to 1. In 2011, it hit 3.1%, a ratio of 33 to 1. We are currently at 2%. If this cycle only reaches the 2011 ratio, and if gold reaches the $8,000 to $8,500 range, then 3.1% of $8,500 is $263, and 6.5% of $8,500 is $552. The $300 to $500 range sits directly between those two historical extremes. It's not a random number. The third pillar is the most straightforward. Eric Sprott, cited directly in the interview, made this calculation. Take silver's 1980 peak at $49. Now adjust that price for the growth in M2 money supply since the late 1970s. The quantity of dollars in circulation has expanded enormously through 4 decades of quantitative easing, deficit spending, emergency lending programs, and pandemic-era stimulus. What price would silver need to reach today just to be at the equivalent money supply adjusted level of its 1980 peak? The answer lands well into the hundreds, not because of exotic theory, but simply because there are vastly more dollars in existence today than in 1980, and silver has absorbed a very small fraction of them. At $74 today, silver is cheap in monetary terms. There's significant catch-up potential baked into the math. But here's what I find most interesting about the entire analysis, and it's not any of those 3 numbers. It's something more qualitative. The argument is that entities that attempt to suppress this process don't stop it, they compress it. A market held below its true equilibrium for an extended period accumulates potential energy like a compressed spring. When the restraint finally breaks, the release doesn't simply bring the price to where it should have been, it carries it past that point. It overshoots, because the buyers who were denied access at $20, $30, $40 are still bidding. Because the sellers who built short positions, assuming the low price regime was permanent, are suddenly facing margin calls at $80, $90, $100, and they're forced to cover. That forced buying creates more buying, which creates more short covering. A self-reinforcing loop. The way it was described in the interview. You can see $10 and $20 up days, one after another, driven purely by the release of compressed pressure. That's not hypothetical. In January 2026, silver moved from $80 to $121 in 3 weeks, $41 of upside in 21 days. That is in the record. The argument is that January was the first compression release, not the only one. I want to be straight with you about what I don't know. This analyst could be wrong. Even people with genuine track records miss calls. The momentum structures he tracks could be signaling something that price never confirms. A market that looks like 1979 can always decide not to behave like 1979. The Iran conflict could de-escalate. The Fed could surprise the market. China could lift its silver export controls. The eligible silver holders sitting inside COMEX vaults could convert en masse, flooding registered inventory and relieving delivery pressure. Any of those developments would change the picture. There's also an objection I keep hearing. The Iran war is short-term bearish for silver. Higher oil means higher inflation expectations. Persistent inflation means rates stay elevated longer. Higher rates reduce the appeal of non-yielding assets like silver. That logic is real, and it has already moved silver from 93, where it was trading when the conflict began on February 28th, down to 74 today. I'm not dismissing that narrative, but there's a counter-argument that I think is more powerful over the medium term. The same war that's pushing oil prices higher is simultaneously accelerating the global energy transition. This week, Britain mandated solar panels and heat pumps in all new homes, citing the Iran conflict explicitly as the policy driver. The head of the IEA stated that nations are pivoting to renewables as a matter of geopolitical security. Every solar panel requires silver, and unlike silver in circuit boards, where quantities are small and partial recovery is at least theoretically possible, The silver embedded in photovoltaic cells is economically unrecoverable. Once it's mounted on a rooftop, it's out of circulation for 25 to 30 years. The Iran war's short-term effect on silver is bearish. Its structural medium-term consequence runs in exactly the opposite direction. And the physical market. Vaults still draining, delivery demand still running above historical norms despite a 42% price correction from the January high, suggests that the structural buyers are not sitting on their hands waiting for the price to stabilize. They're moving now. Let me also say something directly about the correction, because I know a lot of people who entered in January are sitting in a difficult spot right now. Down 42% from the high in 3 months is a real number. It's not easy to hold through that. But I looked at how corrections have played out in previous precious metals bull markets. Gold ran from its 1976 corrective low near 100 all the way to the 1980 peak near 850. Roughly an 8-fold move, not in a straight line, but through corrections of 20, 25, and 30% along the way. Corrections that felt exactly like the end of the move to anyone sitting inside them. The gold bull market from 2001 to 2011, from roughly $250 to $1,920, included violent pullbacks that looked like cycle endings to the people experiencing them. A 42% correction on silver within that historical context sits inside the normal range of what happens during secular bull markets in monetary metals. The momentum structure that matters was not destroyed by the correction. It bent. It did not break. And in that framework, the underlying move is still intact. Let me close with the timeline, because I think it puts the full scale of what we're talking about into sharp focus. 2 years ago, silver was at $29. 1 year ago, $28. October 2025, $52, the first close above $50 in history. January 29th, 2026, $121.67, the all-time nominal record. Today, $74, pullback and consolidation, vault drain continuing. April 1st notice day, 3 business days out. And the analyst who called the 1987 crash, who was publicly long silver at $70 with a $100 target, who correctly identified the January correction as a pause rather than a reversal, is now on record with a next destination of $300 to $500. What strikes me looking at that timeline isn't the speed, though the speed is extraordinary. It's the structure. We're not talking about an asset that had 1 good year on momentum and sentiment. We're talking about an asset that spent 50 years capped at $50, broke through that ceiling for the first time in history, reached $121, corrected 42%, and is now consolidating above the breakout level. While the physical vaults keep emptying, industrial demand keeps accelerating, and the same geopolitical conflict that's pressing the price lower is simultaneously building the structural demand that will eventually override it. The 6-year supply deficit has not resolved. China's export controls remain in place. The COMEX coverage ratio is at 13.5%. Eligible holders are not converting. The April delivery cycle is incoming. Nobody knows exactly where the price goes from here. I don't, and anyone who tells you they do with certainty is selling something. But the framework is logically consistent. The physical data supports the fundamental premise. And the 12-month scorecard, silver miners plus 126%, S&P plus 14%, Bitcoin minus 21%, makes it fairly clear which side of this has been reading the situation right. Bullish or still on the fence? Tell me where you stand in the comments. I'm John Ag. Stay sharp.